You want to buy a brand new house? Over 30% of the cost is going to the local governments. You want to buy a house outside of Canada? Yes, we can make that happen with our good friend and mortgage broker, Mr. Dion Beg. Also in this video, we talk about the looming interest rate. Is it going to go down? Just maybe. Here we are, my friends, with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
I'm great today, man. How you doing?
I'm doing excellent. Excellent. We got some sunny weather finally. I think we're obviously into May, and May, as we talked about last week, May is typically that season of renewness. Renewness, is that a word? It is today.
Sure, we'll take it today. Sure.
Yeah. Well, I feel like the Canadian government is making upwards as we move along here anyways, and that's what we're going to talk about today. A few things that Dion and I have kind of teed up. Of course, we're going to talk about, why our home price is so expensive in a sense and the grand scale of things. Where could we possibly go with our interest rate? And I know you get this question a lot. Dion, I want to move out of Canada or I want to buy a second property outside of the country. We'll talk about that. But talk to us quickly, just maybe on some of the most recent conversations you're having with some of your clients, whether it be on a new purchase or a refinance.
Yeah. So recently, just this morning, I had a client call me talking to renew their mortgage. And they're like, okay, what renewal term should we take? When we're looking at the options, put simply, a 1 year, this is very interesting. A 1 year was at 7.09. This is with a major bank, right? 7.09. Their 3 year was at 5.19, and their 5 year was at 5.24. Okay, so looking at the options, understanding the landscape, we decided to go for the 3 year for that client because again, as much as we still have faith, even though we've been told this message for a while, rates are coming down, rates are coming down, we still have faith that at least within the next 3 years, Gary, I'll make a bet on this. Within the next 3 years, rates will come down. Right. And so also this lady needed some stability. And as much as she could have taken a variable, which would have still put her up in the sixes, by the way, we decided that it was best for her to take that 3 year. It's going to give her the stability she needs. It's a middle of the road number. And within 3 years, look, I think we all know that all going well, all going normal, interest rates will be certainly down. If not at the very next Bank of Canada meeting, it'll be sometime this year.
Yeah. Okay, so remind us again what that 3 year rate looked like for that client.
That 3 year was at 5.19.
5.19. Our next rate announcement, as we all know, is coming up in June, the first week or so in June. And I don't know about you, Dion, there's a lot of pundits, we'll call ourselves in a sense, really on the fence on this one. It can go 50-50, meaning we're going to stay and do nothing, or there might be a slight rate decrease. You have any gut feeling of where we're headed there?
Yeah, see, it's always changing on a week by week basis. If we go back to December, the Fed governor came out and said, this is in the United States. They came out and said, it looks like we've done enough and it looks like rates are going to come down. And on the back of that, in January of this year, all the media guys were reporting, yep, the Fed's going to drop rates this year. And everybody was guessing somewhere between 4 to 6 drops, which would be anywhere from 1 to 1.5% drop. Okay. For that to be true, and now we're in May, for that to be true, we probably needed to have at least one by now. And it didn't happen in the United States. Now, what's been happening in Canada is it's kind of like the Bank of Canada Bank of Canada, Tiff Macklem here, is waiting and playing a game of chicken. And he's trying to hold position as long as he can, because if the Fed moves, it makes his move very simple, very easy, right? Because we just sort of step in lock with them. But there's discussion now about the fact that, look, the Canadian economy is suffering much more so than the US economy, right? We talked about GDP growth, and in Canada, the government loves to use GDP, that is national GDP, as a measure of growth. Whereas if we look at GDP per capita per person, which factors in population growth, we haven't grown at all. In fact, for the last several quarters, we have had a contraction in our economy. Okay. That is not true in the United States. The United States, productivity is up, consumption is up. And so the US has less of a need or a fewer of the indicators for rate drops, whereas we do up here. So Tiff Macklem last week came out and said that we do not need to hitch ourselves directly. I think you've got a quote there, Gary. Could you just pull that
Yeah,
one up, actually?
this up. So I'm going to share my screen here, and I think is it this one? Let's go to
I
this
think,
this one.
was it
So
this
I'm
one? Yeah.
Yeah, let me just scroll down here to this quote here. So this is from BNN Bloomberg just the other day, and Macklin made some comments, and the biggest one, or one of the biggest ones, excuse me, is our interest rates in Canada don't need to be the same as the U.S. rate or global rates, but it goes on to say there is a limit to how far they can diverge, and we're going to break that down in just a minute. So talk to us a little bit about that, Dion.
I'd say
That
the very next sentence there too. We're not close to that limit, and what
mm,
he's basically saying is we can diverge from the rates that exist in the states, as long as it's within a limit. And he's saying we're well and truly within that limit, meaning we can, right? Meaning he's basically telling the Canadian economy, hey guys, even if the Fed does not move, I'm putting up my hand now to say we could very well move and we'll still be okay as an economy. So the fact that he's coming out using that language, language from these types of leaders is huge, because what it does is it gives guidance to the economy as to what to expect. And now that he's chosen to come out and say these words means that now people are expecting it to happen, right? Now, if and when it doesn't happen in June, then everybody's expecting it for the next one.
yeah, and if you were to ask me, I my gut tells me it'll be on that next one in July. And as we go on to read here too in the same article, this is pretty interesting here. I'm trying to find the next quote,
Yeah,
Dion.
BMO under the go up the top there, Gary. There you go. Yeah.
Right here. Yeah, the BMO chief economist. The reason interest rates can't diverge too much is because that would lead to a significant depreciation of the Canadian dollar relative to the US dollar. So often many people say, well, why can't we just do what we want to do? And yes, we can. However, when our economy is so tightly knit with the US economy, that becomes a slippery slope pretty quickly, right?
Yeah, and I'll just put it really simply. Let's say that, okay, Canadian dollar devalues. Canadians go, oh, what's the big point? I don't care. But if that means that you're buying stuff from the United States, it means you're paying more for that. What then happens is inflation. And so it's this very fine balance of trying to make it all work. And one move here does impact other things internationally, which then impacts us back here.
Mm-hmm. Yeah, yeah. So it is, it is important that we watch what's going on in the states, and they've also, as you just said earlier, the expectation there they'll start dropping rates somewhat, but their economy is doing much better than ours, as you mentioned, as we kind of sum this part up. So there's it'll be interesting to see what happens over the summer months for sure, for sure. Anyways,
Yeah.
so rates are coming down over the next 3 years, Dion. Dion said it here first.
Guaranteed.
Yeah, that's right. That's right. Okay, let's talk a little bit about just a little bit about the cost of housing, and to kind of put a bigger a big picture on it, on where we're at today. And this is a post or a tweet that was sent out by Daniel Foch, and what we're looking at here is the price that it costs for a developer to put up a new home. The price meaning what they have to pay on development charges or fees to the government. And you can see over 30% of that purchase price goes to the government for fees. And you had a good insight when you looked at this too, Dion.
Yeah, so I mean, as much as 30%, it sounds ridiculous, and we're looking to the left of the graph saying that's better. It's still 25. So if we go back 12 years to the year 2012, it's still 25%. So put that in context, Gary. Let's just say the average house in the GTA is $1 million. If we're producing a property worth $1 million today, we're spending $310,000 of that $1 million cost is going directly to the government. and a better number is $250,000. Both of those numbers sound ridiculously high, and I think that government bureaucracy and inefficiencies probably have to be reviewed at a time like this. Um, Look, at this point, if we get back to 2012 levels, that'd be great. But then we might have to question even those levels and see if we could do any better than that. Because, look, so many developers right now are throwing their hands up saying, look, I'm not going to develop. I'm not at these interest rates and these development charges combined. No, I'm not going to build, which is impacting supply. I understand also a lot of developers have filed for bankruptcy in the last couple of years because of things such as this, right?
I'm doing some math here, Dion, as we always like to do. And of course, my calculator, this is here. Let me flip this over here. Let me flip this over.
Oh
So
no, live math, live math.
we
It's
should
always scary doing live math, Gary.
now the average Canadian house costs $730,000 as it stands today. And
Sure.
I just did some quick math, times 30%, times 500,000, because that's about the number of new homes we have to build every year, right? Over the next
Right.
several.
Right.
And of course, it came to this, so I got to flip it.
Billion? Is that billion?
Yeah, there we go. So 113, is that 113 billion? Is that what that number says
Yeah,
there?
that's effectively nine. Yeah, billion. It is billion.
We're into the billions, my friends. So on one hand, that's the amount of potential revenue. We won't call it income because it's revenue. Of course, they have government still has expenses out of that, believe it or not, that they're looking to generate per year. We've never really thought about it from that, or at least I haven't from that perspective of how much revenue is going into the Canadian and the local governments from that perspective, right? That's kind of interesting.
Yeah, I think that we all agree that we need development charges. We need allocations for parks and roads and sewer and water and all of that. We get that. But there must be a line where we could be more efficient,
Hmm.
right? And I think this goes for any government department, housing or otherwise. If they applied the same standards that private sector businesses do to the levels of efficiency, they would find ways in which to cut those costs.
Yeah,
Yeah.
that's a good point. That's a good point. Good stuff. Good stuff. Okay. So we also mentioned off the top that you often get inquiries from clients that are tired of paying all those development charges and everything else, and the question coming back to you is, Dion, how can I go buy a property outside of Canada, whether it's down in the Caribbean somewhere? What do we do? How do we do that? Can we do that, Dion?
Yeah. So the short answer is, of course, you can. Anything is possible. The question is, pricing, interest rates, complexity of bureaucracy, and are you willing to put up with all of that, right? So just in the last couple of weeks, Gary, I've helped people purchase stuff. Well, discussed purchases in Trinidad and in Costa Rica, and on the reverse side, so that's Canadians buying overseas, and then I've also been talking with people overseas buying in Canada. So first, we'll talk about these Canadians who are buying overseas. So, guys, a lot of people call me and say, "Hey, Dion, can you help me get a mortgage in Canada to buy the property in Dominican Republic, for example?" So the short answer is I can help you get funding for that property, but it won't be secured against the property that exists overseas, because me and my brokerage and every brokerage in Canada is licensed to operate in Canada, and the lenders will only lend on security, that is real estate, that's based inside of Canada, right? So how are we helping this person buy in Dominican Republic? Well, we're helping them access equity from their properties here in Canada, and then grabbing that equity and dropping it on the purchase of the overseas asset. Now, sometimes clients can pull the entire amount from the equity they have in the existing property. So they need 400 grand, we'll pull the 400 from here. They just pick it up from Canada and they just buy that place cash. That's one option. The other option, though, is of course they could try and get financing. Now, you know what confuses people, Gary, is when they go to Jamaica or they go anywhere in the Caribbean, they might see a Scotiabank or they might see an RBC or a CIBC, and they go, "Oh, I can just get a mortgage from Scotia, and it'll be just the same." But it's very different, right? And so let's just say Scotiabank in Jamaica is its own business entity, right? Even though they have obviously Scotia in Canada, they operate while similarly operated, they're a different business and they have different qualifying criteria, similar but still different standards and different processing times. This is a huge thing, right? So if you think getting a mortgage here is slow and tedious and high in documentation requirement, well, try and get a mortgage in the Caribbean. If you're not willing to sign up for a 6-month experience, don't start, right? And I can tell you this from experience with a lot of my clients, colleagues, and friends who have purchased internationally. Some of them, originally from these Caribbean nations, they will tell you that, yeah, if you don't have around 6 months to close a deal, then don't start. So it's all possible. You will likely get qualified to, if you can qualify for that money to buy a place in Canada, you'll likely qualify to buy that place in the Caribbean, but it'll be a much longer process.
Interesting, interesting. That's
Mm-hmm.
good insight though, because we assume, like you said, we see those banks that we're so familiar with. We're like, yeah, it'll
Mm,
be the same process, and
yeah.
obviously,
Yes. A lot of people think they'll just walk into their local Scotia and give the paperwork. They're like, no, we can't help you. You have to transmit those docs all the way to the Caribbean country or the overseas country, right? Same in, I mean, if you're driving in the United States, you'll see TD Bank down there on a bunch of corners now. They're one of the larger banks, especially in the north. So, but again, same goes, right? You're gonna if you're trying to buy in Florida, for example, same goes.
yeah, yeah, and perhaps we should spend some time talking about that in one of our future episodes. We do have colleagues that not necessarily are going all the way to, we'll call it the Caribbean, but are looking for that second property, perhaps, or even an investment property, and we'll call it the tax-free states, as I like to call it, the Texas and in
Mhm.
Florida. We do know. We have our own friends and colleagues that are doing that, and how are they doing that? Perhaps is the conversation we should have. Very good, Dion. How do people get a hold of you?
Okay, kangamortgage.ca or Instagram at the Dion Beg.
There you go. The Dion Beg. I'm the Gary McGowan. We'll see everybody in the next episode. Goodbye for now.